Las preguntas que muchos se hacen son: ¿ha llegado ya el suelo del mercado? ¿Cómo nos protegemos frente a la inflación? ¿Cuál es el futuro de la política monetaria? Para responder a esta y otras preguntas, contamos con Nicholas Davidson, que es Senior Portfolio Manager Equity en Alliance Bernstein. Welcome, Nicholas, for having us.
Good afternoon, Fernando. Thank you for having me.
Nicholas, how is the evolving outlook for inflation and interest rates affecting equity markets?
Well, there have certainly been times recently when investors appear to be thinking about nothing else, that they're spending all their time parsing, perhaps over-interpreting every comment that the Federal Reserve makes. But clearly, the outlook for both inflation and interest rates is having a huge impact on markets. If I take inflation first, inflation in and of itself is not necessarily bad for equity markets. For some companies, if they can pass cost increases through, it can actually be beneficial for margins. For others who can't do that, it can be more of a problem. I think what's causing more consternation for investors is the reaction of central banks to high inflation. And obviously what we're seeing is big increases in interest rates at a very rapid pace relative to history, and that has a couple of effects. Obviously it weighs down on equity valuations, but it also, by potentially slowing economic growth further, can have an impact on earnings. And clearly a lot of the uncertainty at the moment is about, well, how is that pace going to go? Are we going to see that effect? In terms of how that's likely to evolve, it's obviously difficult to say. Some of the supply-constrained driven inflation we're certainly seeing, I think, peaking. If you look at metrics like shipping costs, they're probably coming down, even energy prices in Europe, but particularly in the US, it's not clear that we're yet seeing any slowing in more domestically driven inflation, and particularly inflation that may be coming from a strong labour market. So there, I think, the outlook does remain pretty uncertain.
And also, political events seem to have been having a big impact on markets recently. Do you see that political events continuing?
Yes, I do. And indeed, you could put it the other way around. I mean, here in the UK, we've seen the markets having a very big effect on politics. The rather short-lived nature of Liz Truss's government obviously owed a great deal, in fact probably most of it, to the reaction of the bond markets. But the other way around, you can see it very clearly in what we were just talking about, that a big part of the inflation that's driving higher interest rates, that's causing volatility in equity markets, obviously comes from the war in Ukraine, an enormous geopolitical shock to markets earlier this year. We've seen it in a slightly less dramatic but very interesting way in China. The Chinese offshore market was down 6% on Monday, which is the biggest fall since the financial crisis in 2008, mostly, I think, because investors saw President Xi exerting an even greater degree of control, reflected in the choice of members of the Standing Committee of the Chinese Communist Party than had perhaps been expected. And that's increasing fears, maybe, of further potentially market-unfriendly interventions in the markets. Now, this year, maybe the impact of geopolitics has been unusually extreme. Certainly, it's a salutary reminder, I think, to investors that you can never ignore political risks and need to pay close attention. It may be that is now peaking, and that in 2023 we'll see less of effect. Obviously, we have the US congressional elections coming up. Past history suggests they're unlikely to have a huge impact on markets, but plainly tensions between China and the West, something that's going to go away, and that is going to continue to impact markets going forward.
And another issue that is affecting the economy globally is the US dollar. Can it go on strengthening?
It certainly can. We've seen it come down a fair bit in the last 4 or 5 days, but even after that, the dollar is still looking pretty expensive relative to most other currencies, which would typically be a source of weakness. And obviously, of course, the US trade deficit is also very large, and long term that would normally also apply downward pressure on the dollar. But on the other hand, what's really been driving the dollar, and which I think hasn't finished, is those rapid increases in interest rates driven by the Federal Reserve that we've seen in the US, which have been more rapid than in most other developed countries. Plus, of course, the dollar has benefited from a significant safe haven status among a lot of those geopolitical risks that we've seen. Now, the rise in the dollar isn't all bad for European investors. Obviously, it's muted the degree to which their non-European assets are down this year. But on the other hand, it's clearly exporting inflation to the rest of the world. So can the dollar's rise continue? It certainly can. We're seeing a pause. My guess, and it's not much more than a guess, is there's probably a bit more dollar strength still to come.
Now, Nicholas, the big question, might equity markets have bottomed?
Well, again, it might. I think, you know, if we go back to what's really driving the falls in markets this year, the rise in interest rates and the effect on valuations. Now, it may be, and I think this is more likely outside the US, in the US, that effect is now done, that equity valuations have fully adjusted to a higher interest rate environment. In terms of the secondary effects, the impact of interest rates on the economy and therefore on company earnings, I think it's less clear that effect is fully done. As always, much is going to depend on companies' earnings, and we're still at early stages in this earnings season, and we've seen quite a wide variety of different results. Obviously, some pretty negative reactions to some of the big technology companies' results, where maybe digital advertising spend, for example, has not been quite as resilient in the face of slowing growth as some had hoped. On the other hand, quite a number of banks, some more cyclical companies, as well as some more defensive companies like Coca-Cola, have produced good earnings. So, you know, I think we'll see how earnings evolve, and particularly how the economy slows, how quickly the US economy slows next year, how big an impact that has on earnings. It may be that we've bottomed. It may be that actually later on in 2023 we see more of a slowdown in the US, and it's not till that happens that you really start to see a firm bottoming of equity markets. Too soon to say, I think, is the short answer.
Mm-hmm. And which regions equities are likely to do best going forward?
So on a long-term valuation-based perspective, as I hinted already, I think it's clear that you've seen a bigger compression of valuations outside the US, relative certainly to history, than inside the US. So on a long-term basis, the valuations of non-US companies probably look more attractive. On the other hand, the immediate downside risks, both economic and otherwise, are also probably greater and more obvious outside the US. So I think, as always, the answer is that investors need to have a well-diversified portfolio. Emerging markets have suffered a lot recently. It may be that we're starting to see a period where emerging market growth is faster than in the developed world, and typically when that's happened, that's been when emerging markets have outperformed. So I think despite the significant underperformance of emerging markets recently, investors should keep an allocation there. So I think for European investors, absolutely not the time to abandon a decent allocation to the US, but they shouldn't be ignoring their home markets either.
What can equity investors do to protect their returns in this worrying environment?
Well, it's a key question, Fernando, and I think the first thing they need to do is to stay invested. As we've seen many times in the past, the rebound can be pretty violent and unexpected when it comes, and if you miss a large chunk of that, then you're going to miss out on a big part of the return that equities offer. But also, I think it's important to try to find, if you can, portfolios that can protect on the downside. If you lose less when markets are down, then there's less to make up as markets rebound. And so at AB, for example, we offer a low volatility portfolio which aims to do that. And particularly It does it by buying companies that have got more resilient earnings in a downturn, so they're more stable typically in terms of stock price performance. We want companies which have got strong cash flows, typically protected by some kind of competitive advantage that gives them pricing power in a more recessionary environment, again, crucial in protecting returns. But you want to combine those qualities with valuations that are attractive. You don't want to be overpaying for more stable companies or for higher quality companies. And by not overpaying, by emphasizing valuations too, what we found is we can somewhat moderate the impact of valuation compression that's come from high interest rates. And I think that's going to continue to be important.
Well, thank you very much, Nicholas, for sharing with us your knowledge, your expertise, your economic analysis. Hope to see you soon here in Negocios Televisión.
Thank you, Michael.